Hi everyone! Following my previous macro video on Chinese stocks and also a very interesting comment from one of you, today we are going to take a look at a new company, Tripcom. Tripcom was founded in China in 1999 under the name Ctrip, at a time when the domestic travel market was still very fragmented and most bookings were still made offline. The company initially built its position around hotel reservations and airline tickets. Then, as Chinese consumers started traveling more frequently, Ctrip gradually expanded into rail bookings, package holidays, corporate travel, and other services used during a trip. Over time, the model became much broader. Someone booking a flight could also reserve a hotel, arrange an airport transfer, or find an activity at the destination. By covering more parts of the same journey, Ctrip could increase the amount spent through its platform, while also making the whole process easier for the traveler. The company built this one-stop travel model around three main strengths: inventory, technology, and customer service. Brand and service are particularly important in the travel industry because when you have cancellations, delays, or unexpected events, customers are often reluctant to rely purely on the cheapest option. Ctrip also strengthened its position through acquisitions. In 2015, it consolidated Qunar, one of its largest competitors in China. This reinforced its domestic presence, particularly in hotels and transportation, while also reducing competition between the two platforms. The next step was international expansion. In 2016, Ctrip acquired Skyscanner, an established global travel search platform. This gave the group access to international users right at the beginning of the booking process. Today, the group operates through four main brands, each with a slightly different role. Ctrip remains the flagship platform in China and offers the broadest range of travel services. Qunar is the other major domestic platform and has historically been more focused on search, comparison, and more price-sensitive customers. Tripcom is the main international booking platform where users can directly complete and manage their reservations. And Skyscanners operate earlier in the process, helping travelers compare the different options available before redirecting them to an airline or booking platform. Tripcom is still mainly a Greater China business, with a region representing 83% of revenue in 2025. But the international share has increased from 9% in 2017 to 17% in 2025. Of course, the COVID period distorts the picture, especially in 2022. China was still affected by strict travel restrictions, while international markets had already started to recover. So temporarily, the international share increased to 19%. But even once we remove this exceptional period, the broader trend is still clear. International activities are gradually becoming a larger part of the company. In Greater China, revenue increased from RMB 24.7 billion in 2017 to RMB 51.7 billion in 2025. So the business more than doubled over the period, despite going through the largest crisis the travel industry has ever experienced. Internationally, revenue increased from RMB 2.3 billion in 2017 to RMB 10.8 billion in 2025, so almost 5 times higher. The acquisitions we discussed earlier, especially Skyscanner, helped the group establish a presence outside China. More recently, the performance also reflects the development of Tripcom itself as a direct international booking platform. The international business is still much smaller than Greater China, but it's growing significantly faster. So over time, Tripcom is gradually building a second growth engine outside its domestic markets. At the group level, revenue increased from RMB 10.9 billion in 2015 to RMB 62.4 billion in 2025, despite the major disruption caused by COVID. And the momentum continued into the first quarter of 2026, with revenue reaching RMB 16.2 billion, up 17% year-on-year. Growth was supported by the recovery in cross-border travel and the continued expansion of the international business, particularly inbound travel, while demand in China remained resilient. More broadly, this growth has been supported by rising travel demand across Asia and the long-term shift from offline travel agencies toward online and mobile booking. Looking at the revenue mix, there are two main developments I find interesting. Package tours declined from 15% of revenue in 2015 to 8% in 2025, reflecting the gradual shift toward more flexible and independently organized travel. At the same time, the other segment increased from 2% of revenue in 2015 to around 10% in 2025. Travel suppliers can pay Tripcom for advertising and additional visibility across its platforms. The group also receives fees from financial institutions and generates income from financing provided to some users. So these activities allow Tripcom to generate additional revenue from the traffic and transactions already passing through its ecosystem. The core business model itself is fairly straightforward. Tripcom brings customers to hotels, airlines, and other travel providers and receives a commission or service fee when a reservation is completed. So the company mainly acts as an intermediary. There are two particularly important expenses in this business: product development and marketing. Tripcom continues to invest heavily in technology to improve its booking platforms, connect suppliers, and automate more of the customer journey. Marketing is also a major expense because the group still relies significantly on performance channels to attract users and direct traffic toward its own platforms. In 2025, product development and sales and marketing each represented around 24% of revenue. If we exclude the COVID period, profitability has improved significantly. The EBITDA margin increased from 17.2% in 2019 to around 27% to 28% between 2023 and 2025. The main driver here is operating leverage. Tripcom has spent years developing its technology, integrating acquisitions, and building the infrastructure needed to operate at scale. Technology spending is still increasing in absolute terms, but revenue is now growing faster than these costs. Once the platform is in place, it can process a much larger number of bookings without expenses increasing at the same pace. And over time, this supports higher margins. Marketing also creates an interesting connection with the current debates around artificial intelligence. In the future, AI assistants could increasingly become the starting point for people organizing a trip. For Trip.com, I think this could mainly change the channel through which traffic is acquired. Part of the marketing budget currently spent on search engines and other performance channels could gradually move toward AI platforms that redirect users to Trip.com. The risk is probably greater for comparison platforms such as Skyscanner and Qunar than for the core booking activity. A traveler could start searching for a trip through an AI assistant, but at some point the reservation still needs to be completed through a platform connected to hotel and transportation inventory, with the ability to process payments and manage the booking. Trip.com also has years of customer and travel data and is already integrating its own AI tools into the ecosystem. So overall, I don't currently see AI as a major threat to the core business. The combination of revenue growth and margin improvement has translated into a strong increase in profit and earnings per share. But there are two adjustments we need to make to read this chart properly. The first one is dilution. The number of shares outstanding increased significantly over the period, mainly because of shares issued for acquisitions and strategic transactions, as well as employee stock option plans. As a result, earnings per share increased less quickly than the group's total profit. The second issue is the exceptionally high level of reported EPS in 2025. Trip.com sold around 34 million Make My Trip shares and recorded a gain of RMB 15.2 billion. Once I remove this disposal and the other non-recurring financial effects, I estimate a more conservative normalized EPS of around RMB 23.3 per share, compared with a reported RMB 50.6. In the first quarter of 2026, we had the opposite effect. Reported diluted EPS fell by around 40% to RMB 3.67, mainly because Trip.com recorded an RMB 876 million valuation loss on its investments, compared with a gain 1 year earlier. Once we remove these financial market effects and share-based compensation, adjusted EPS came to RMB 5.73, down only around 4%. But there is another adjustment I think we need to make. This adjusted figure also excludes RMB 691 million of share-based compensation, up from RMB 480 million 1 year earlier. Share-based compensation doesn't create an immediate cash outflow, but it is still a real cost for shareholders. Either shareholders are diluted, or the company has to spend cash on buybacks to offset that dilution. So I prefer to keep this expense in my calculation. Doing that gives me a more conservative normalized EPS of around RMB 4.7, which represents a decline of approximately 11%. Looking at the balance sheet, the improvement since 2023 is quite clear. At the end of 2025, Trip.com had a reported net cash position of approximately RMB 46.8 billion. After deducting customer advances, I estimate adjusted net cash at around RMB 28.8 billion. That's a meaningful adjustment, but it doesn't really change the overall picture. Trip.com has significantly strengthened its balance sheet and is now in a healthy financial position. Negative operating working capital is also consistent with the business model. Trip.com often receives money from travelers before it has to pay hotels, airlines, and other suppliers. However, this position became less favorable in 2025, mainly because of higher prepayments and deposits, together with an increase in trade receivables and receivables related to financial services. And this was one of the factors behind the decline in free cash flow. Free cash flow per share decreased from RMB 29.1 in 2024 to RMB 20.65 in 2025, despite the continued improvement in the underlying business. Even after this decline, the stock trades at around 13.6 times 2025 free cash flow, which I still consider a reasonable valuation. Before moving to valuation, there is one major uncertainty surrounding Trip.com today that we need to discuss: regulation in China. In January 2026, the Chinese market regulator opened an investigation into whether Trip.com had abused its dominant position. We still don't know what the final outcome will be, but it could potentially lead to a financial penalty and changes to some of the group's commercial practices. To get an idea of a possible fine, we can look at previous cases involving other major Chinese platforms. Meituan was fined the equivalent of 3% of its domestic revenue, while Alibaba received a penalty equal to 4%. If we apply the same range to Trip.com's 2025 Greater China revenue, we get a potential fine of approximately RMB 1.6 billion to RMB 2.1 billion. Given the current balance sheet, Trip.com should be able to absorb a penalty of this size without too much difficulty. The bigger question is what happens after that. The regulator could require lasting changes to commissions, hotel pricing, supplier contracts, or the way Trip.com uses its market position. And changes like this could put recurring pressure on margins rather than simply creating a one-off financial charge. We may already be seeing some short-term pressure. After revenue growth of 17% in Q1 2026, Trip.com now expects growth of only 3% to 8% in Q2, with a corresponding impact on margins and profits. Part of this slowdown is linked to compliance-related operational adjustments. At the same time, higher energy prices and geopolitical volatility are also affecting the company's guidance. So at this stage, it's difficult to isolate exactly how much of a slowdown is coming from regulation. So now we can move to valuation. Estimating a clean level of earnings for Trip.com is a little more complicated than simply looking at reported EPS. Investment gains and losses create a lot of volatility, while the higher level of share-based compensation and the potential long-term impact of regulation also need to be taken into account. So I start with a normalized 2025 EPS of RMB 23.3 that we calculated earlier. Then I use the level of share-based compensation recorded in Q1 2026 as a proxy for the new structural level going forward. This reduces EPS by approximately RMB 0.7 per share. For regulation, I assume a recurring decline of 1.5 percentage points in the group's EBITDA margin, which will reduce EPS by around another RMB 1.1 per share. That brings me to normalized EPS of around RMB 21.5 per share. With the current share price at around RMB 284, Tripcom trades at approximately 13.2 times normalized earnings. I don't include the potential antitrust fine in this normalized EPS calculation because it will be a one-off expense. The margin adjustment is there to represent the potential recurring impact of regulation on the business. So, with this valuation in mind, we can now look at the company's long-term growth potential. For the next 10 years, my central assumption is around 7% annual revenue growth in Greater China and at least 12% internationally. The international business is still much smaller, which gives Trip.com more room to enter new markets and gain market share. Based on the current geographical mix, these assumptions would translate into group revenue growth of around 8 to 9% per year. And at 13.2 times normalized earnings, I don't find the valuation expensive for a company with this level of expected growth. Another positive point is the tourism potential of China itself. For many years, China has been viewed through a relatively negative lens in many Western countries, and it's still not always seen as a major tourist destination. But I think this perception is slowly starting to change, as more people discover the quality of the infrastructure, the historical sites, and just how diverse the country actually is. Inbound tourism has already recovered strongly, but in my opinion, it still remains below its long-term potential, particularly when we look at travelers from nearby Asian countries. And if this trend continues, Trip.com should be one of the main beneficiaries because of its strong domestic position and its ability to connect international travelers with local hotels, transportation, and activities. The comparison with Booking and Expedia is also interesting. Over the last decade, Booking has clearly widened its lead, while Expedia has gradually lost ground relative to it. Trip.com is still the third largest of the three by revenue, but its international business continues to expand rapidly. And over time, this gives the company a credible path to gradually narrow the gap with Expedia. If international business continues to grow faster than Expedia, Trip.com could potentially become the second largest of these three groups over the longer term. There is also a significant valuation discount. Booking currently trades at around 19.6 times normalized earnings and Expedia at around 20.2 times, compared with approximately 13.2 times for Trip.com. Some of this discount is justified. Trip.com is a Chinese company and therefore carries greater regulatory risk. Booking may also deserve a premium because its execution and revenue growth have been stronger over the last decade. But when I compare Trip.com and Expedia, I find the discount much more interesting. Trip.com's growth potential is at least as attractive, while its international business still has significantly more room to expand. The main weakness I see today is shareholder return. The dividend yield is currently around 0.7%, while recent buybacks represented only around 1 to 1.5% of market capitalization and have largely been used to offset the dilution created by share-based compensation. So, for the moment, the direct return to shareholders remains quite limited. The company is still prioritizing growth and international expansion, and I can understand the logic of retaining more cash while these opportunities are available. At the current valuation, I can accept this approach. But over time, I would like to see a larger part of that cash returned to shareholders, lower share-based compensation, or a more substantial buyback program. Another short-term risk is the energy market. Tripcom has indicated that higher energy prices and geopolitical volatility could affect travel demand and growth over the coming quarters. However, as I discussed in my PetroChina analysis, domestic energy pricing and refining margins are more controlled in China. So the impact on Tripcom could potentially be more limited than for some of its international competitors. Overall, when I look at the valuation, the quality of the business, and the long-term growth potential, I'm genuinely interested in Tripcom, and if the stock is still trading around these levels when I have more cash available, I would consider adding it to my portfolio. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.